So right now, as I speak, my stocks and shares ISA on Trading 212 is at all-time highs. And I've been very vocal about my losses in the last few months, where I invested £113,000 into the S&P 500 at a time which turned out to be near the very peak of the S&P 500, and then we saw a massive crash after that. So as you can see, this was my big investment, £13,000 into the iShares Core S&P 500. Now this S&P 500 is a hedged fund which in my favor did work out for me, because right now I'm almost fully recovered, even though the S&P 500 technically has not made a new all-time high. So as you can see today, we are almost back to where I was before, just a few months back on the 24th of February. My value is £113,096. I'm filming this live, so there will be some fluctuation. And as you can see, still after all these months, I am still down by 0.13% or a loss of £146. Now from this 1 year graph, you can see that there was almost no dip. What dip are we talking about? Because look at that. So right before the crash, I was at a value of £116,440. And then during the crash, that went down to £96,416. Honestly, it was a very bad day. I was down by about £22,000 in one holding. But if I had listened to people telling me that, this was the crash that was going to crash it all, I probably would have sold if I was actually convinced that that was the case. And, right now, I wouldn't have seen a recovery that was better than my position that I held before the stocks went down. You can see with the S&P 500 index, over the past month, we are up by 2.77%. And now year to date, the S&P 500 is actually up and it's nearing all-time highs once again. Now, I've been making these series for about a year now. When all-time highs arise in the S&P 500, a lot of people get, scared to invest because they think that a crash is imminent. But I've been doing these series around all-time highs. And in this video, I'm going to show you that I have been investing for the past 30 days, £10 every single day into the S&P 500. Now, of course, I have been using Trading 212 for all of these updates. And if you would like a free fractional share worth up to £100, all you have to do is to click the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days, but have not received your free fractional share, all you have to do is to click the 3 horizontal line menu over here. Scroll all the way down until you see the section use promo code. And in this menu, just enter my code JUBAIR and you should receive a free fractional share. So you guys may be wondering how it was possible to reach new all-time highs in my portfolio, although the main holding that I did hold is still in the negative. So like I showed you, my portfolio value before the crash was around £116,000. So I still had £3,000 that was not directly invested into the S&P 500. In fact, it was invested into the Nasdaq 100, which I was investing £100 in every day. And then because I pound cost averaged into that, it was up at a specific point and then just sold out. And the rest is just interest on cash. Now, this particular portfolio is interesting because I actually no longer actively deposit into it. You can see that my ISA allowance is completely left open, not a single penny put into here. Although I have maxed out my stocks and shares ISA allowance this year, just with other brokers, because I do want to just keep this money here for the long term. And I am using these other brokers as a means to save up for a house or something like that. I do want to keep it in my Trading 212 stocks ISA until retirement. But anyway, as you can see, I am actually completely invested into the S&P 500. It is my sole holding in my Trading 212 stocks ISA. You can see I have £3,550 in cash, and that is drip fed into this pie here called the S&P 500 £10 daily. Now, as you can see, my net deposits are £300, so that's 30 days worth of investing £10 every single day into the S&P 500 holding. And I'll show you specifically which one it is and my reasoning behind that. But you can see over the past month, the return for this pie by investing £10 every single day has been pretty positive, a positive 2.7%. And that is a return in terms of pounds and pence of £3.80. Now, if I go into the tab that says holdings, you can see my total return since I started investing 30 days ago, and that is a positive 1.24% or a positive gain of £3.72. So using this pie, every single day £10 is deposited from my free cash into this pie. And this also includes the weekends, so Saturdays and Sundays, when the stock market is closed. Now, this means basically on Monday, £30 is put into the stock market. Unfortunately, you can't invest every single day into the stock market because obviously it's closed. Now, I do intend to keep this experiment going for a while so we can get some good data points and see whether or not, lump sum investing or everyday dollar cost averaging might be a better thing. Obviously, this is not a proper scientific experiment, but it's still fun to see. So the fund that I chose to invest £10 every single day into is this one here. And this is the SPDR S&P 500 accumulating ETF, which tracks the S&P 500 and allows UK investors to invest into it because essentially this is denominated in pounds, so there's no extra foreign exchange fee that you're going to have to pay. Now, the reason as to why I went for this is because this is one of the cheapest S&P 500 holdings you can get as a UK investor with an expense ratio of 0.03%. Now, compared to the Vanguard S&P 500, it is a lot cheaper. The Vanguard one costs 0.07%. Also the same as the IUSA 2, which is the iShares equivalent. Now, if I had invested £300 when I first started out investing into this, as you can see, if I click the menu button on the top left and then go into history, you can see that every day the stock market is open, my orders are automatically placed, and I first started investing on the 12th of May. You can also see that the first time I started investing, the price was £10.74. This means that if I had put in £300 back then, I would have 27.92 shares today. Now let's check how many shares we have instead of just comparing the price. Now this is because this is an accumulating fund, so there's no dividends that are paid out, so we can make a very clear apples to apples comparison over how many shares we would have had back then compared to now. Now the amount of shares that we would have had is a better comparison for value in my opinion because the price just keeps bumping around. So as you can see, we currently have 27.93 shares, but if we had invested 30 days ago and we lumped £300, we would have had almost exactly the same amount at 27.92 shares. So over the past 30 days, there was no significant difference between either lump summing or dollar cost averaging every single day. And now one of the biggest reasons as to that is, of course, this is a pound denominated ETF. So although you're paying lower fees, unfortunately over that time, the pound has been strengthening against the dollar, which essentially means that your investments have less value when converted back into pounds because it costs more to convert back into pounds. And that is one of the reasons as to why something like the VUSA or even this has had a smaller return compared to a hedged ETF. Now you can see this fund here is the iShares Core S&P 500, my main holding, which is a hedged ETF. Now by no means am I promoting this fund. This is not financial advice. This is just what I happen to have invested into. My previous experiments were using this fund, and you can check out on this playlist just how that went. Dollar cost averaging versus lump sum investing. Of course, everything changes based on time periods. There are loads of fluctuations in the market. So it's really interesting to see how these experiments pan out. Over the 30-day period, you couldn't have told me that, there would have been almost no difference in dollar cost averaging or, lump sum investing. So make sure to check out some of my other videos and I'll see you in the next video.